What's up, everybody? Welcome to Heresy Financial. New week, new exciting stuff in the markets ahead, especially considering what's happening in gold right now. Gold is currently experiencing what will probably be its very last breakdown inside of this bull flag, inside of this consolidation zone that it's been consolidating in for the last few months as it makes its probably its last move down. This may be the last chance to buy on a dip before an epic short squeeze initiates on the price of gold and just pushes gold straight up into the stratosphere. Ready? Let's dive in. All right, guys, check out this chart of gold right now. So what you notice here is for the last couple of months, the price of gold has been following down inside this channel. This is a classic bull flag. And a bull flag is simply there's a big move up and then a slow drift down for a while the energy and the movement consolidates. Weak hands get shaken out. Profit takers take their profits. And once that is done, the momentum then continues from what it's been doing for the last 5 years, no less. If we look at when this market in gold bottomed, it was actually back in 2015. And so for a long time, we've got a lot of bullish momentum behind this. So this last few months is nothing to be concerned about. It's very healthy in a bull market to see consolidation patterns like this. If you look at the price of Amazon, for instance, over the last, I believe, like 10 years or so, you see this happening over and over and over again. Price will jump up and then it'll consolidate, and then that energy that builds up, it'll help it build, go back into that momentum, that bull momentum back up. It'll jump up again and then consolidate. This happens over and over and over again in healthy growth asset charts. You see this pattern repeat itself. So we're just seeing the same thing here, and we've been holding support right along this line here. If you notice this line, and even though this channel has still been intact aside from a false breakout earlier in November, been holding stronger support right around the 1850, 1860 mark since September. And so we've seen a tight squeeze forming. And whenever you see a squeeze in a chart, that's you can imagine there's energy building up. That's a coiling. That's the sellers are pushing the highs down, and the buyers are keeping the lows stable, or sometimes you see the buyers pushing the lows up as well. And so either the buyers or the sellers are going to win when that finally breaks. And the tighter that price range gets, the more explosive the move will be once it does finally break out. And so looking at this chart, I was waiting to see whether it would break up or down. And it looks like the sellers have won here and is pushing the price down. So I would not be surprised at all to see us retest the bottom of this channel in gold. That would bring us to about 1790 or 1800 in per ounce for the price of gold. Now, this is a great support line, great resistance line from back in 2012, I believe, when it was trying to get back above this price. And then it was good support and resistance earlier this year as well. And so we've got a lot of support here at this price range. And so the fact that we'll retest the bottom of the channel, we'll get close to the 200-day moving average, and we're testing historical support resistance, means that this is probably the last leg down before we start to see an epic run up. Now, why do I think we're going to have an epic run up, and why won't we just continue this? Well, number one, this selling pattern here looks a little bit like, giving up a little bit like panic selling. And so we're seeing a lot of profit taking here. We're seeing a lot of weak hands getting shaken out, especially considering that this price level that it's at right now is still well above the price that it's been for the last few years. You could definitely see some weak hands looking at this and saying, I don't want to risk losing any more profits. I'm just going to get out here. Now, the second reason is more fundamental rather than technical, and it has to do with the main players, the major players with big money that trade in the gold markets. There are a few main groups of traders and investors that trade in the gold markets. The biggest one is the Bullion Banks. The second one is the hedge funds. And then the third group can't be classified in either of those groups. And so on the commitment of traders reports that comes out for futures trading, this is just categorized as the other group, just everybody else combined. Now, if you look at this chart, you can see that the Bullion Banks, and this is the biggest money involved because these are the gold trading desks at banks. They store their gold in unallocated storage, meaning that they issue a lot of paper claims on gold through the use of futures that if they all tried to be redeemed at once, there's not enough physical gold to back that up. It's well documented. It's not like a theory or anything. It's just the nature of how the futures markets work. And altogether, these bullion banks are massively net short and close to a record net short again. They're up to about 38 billion net short. And so despite the recent drop in the price of gold, they have not reduced their short positions. In fact, it looks like what they've been doing is still been attempting to push the price down, hoping to be able to close out their shorts at even lower prices, probably because they're at big losses on these. And so they're trying to load up their shorts even more, which a short is simply a sell before a buy rather than a long is a buy before a sell. And so they're trying to sell. That increases selling pressure and that soaks up the buys. And so they've been trying to push this price down. Now, when you look at the group that they're normally selling to, it's usually hedge funds, and hedge funds are momentum traders and they're price range traders. And so normally at the top end of these gold ranges, you see the hedge funds starting to cut their longs and take profits. You saw that back in August when the price of gold peaked over $2,000 per ounce. You saw hedge funds massively starting to sell and cut their long positions, which contributed to the drop in the gold price. But they're now doing the opposite. They've been loading up and going long. And the same is true of the other reporteds category where all the other traders are going long. And these are the category that usually stand for delivery. So this is important because you've got two big groups that are going net long versus a large group who is net short, net naked short, and there's not enough gold in the vaults to stand for delivery if everybody who is long decides that they want to take physical delivery. So this is a big setup for a massive short squeeze, especially because the bullion banks, who are net short by almost a record amount, now that we have this drop here below this support level, and as soon as we hit the next level of support, they're likely to recognize that it will be very difficult to push the price of gold down below 1790. It'll be very difficult. There's a lot of willing buyers at that level, basically, and so it'll be very difficult to soak up all the buyers at that level and then continue to push the price back down even further than that, which means that the bullion banks are much more likely to reverse their short positions at that level because that's the lowest they expect it to go. And that buying pressure then, when they close out their shorts, you have to buy a contract back to close it if you're short it. That will push the price back up. And then once it breaks up above this channel, all bets are off. A short squeeze of this magnitude could easily take gold to $2,500 an ounce over the course of 1, 2, 3 trading days. It wouldn't take long at all to see a massive move like that. And if everybody who's long starts standing for delivery instead of closing out and settling in cash, we're going to experience a modern day run on the banks, where back in the old days when you had a run on the bank, it's because banks used to have to hold gold to back up the deposits. And when people caught wind that there wasn't actually enough gold to back up the deposits, they'd go to try to be the first one to get their gold out. And so you'd have a run on the bank and the first people in line got their gold and everybody else was kind of screwed. It's been happening for thousands of years. And today's bullion banks, the gold trading desks, operating in exactly the same way. That's why I always say, if you're going to store your gold somewhere, make sure that the most important thing to make sure is that it's not in an unallocated account, because legally you don't have any ownership of gold. You have a claim on gold. You're owed gold. You don't own gold. There's a very big difference between those two things. And so you and an unlimited number of people might have the same claim to be owed the same piece of gold. And let's be honest, you're not going to come first in line in a case like that. And so we're likely to experience a big run on the banks here, where if they're not able to deliver, there's not enough physical to back up all of the delivery requests. That can explode the price upwards. You can see massive failures of gold trading desks and bullion banks system-wide, and sellers of gold would essentially dry up. They disappear. And so the price at which people are willing to buy just explodes up because there's no volume to be sold at any of these prices. There's no supply available. So it just skyrockets that price up. And so if we do hit the $1,790, $1,800 mark, that would be the price at which I would say that's a back up your truck moment. That's a get all in, get as much as you can moment in gold, because the likelihood that it goes down past there is very, very low, especially after we've had this capitulation moment where we have this panic selling today. And the net short positions, the likelihood that we just have an explosive move up within potentially the next 1 or 2 weeks from now is absolutely huge. So this isn't trading advice. This isn't investment recommendation. As always, it's for educational purposes only, but that's what I see in the charts. And that's what the position sizing of the major gold traders in the industry are looking like right now. So it looks like we are set up to experience a massive short squeeze in gold any day now. So I'm excited to see where this goes. I'm excited to see where this takes us, and we'll have to just wait and see how it plays out. If you'd like to get your hands on allocated gold before the squeeze starts, especially to take advantage of the price drop that we're seeing today, the easiest place that I like to buy metals from that easily store and you can request delivery really easy from and really cheap prices, OneGold. They've got a great user interface, fantastic. I love it. It's very easy. I've tried out a lot of services, very easy. They've got an app and a website. You sign up, you buy gold or silver or platinum with them actually, and they store it in allocated accounts. You can choose where in the world you want it to be stored, whether it's in Switzerland or the United States. You can choose, where you want your vault to be located. And then at any time within the app itself, you can request delivery and you can request what kind of coin or bar you want to be sent to you in order to redeem it in physical once you have enough and you don't want it in storage anymore, you want to take possession. So it's a fantastic service. I love it. So I've got them linked in the description below. And if you use my link, you'll get a free $5 to help start off your account. As always, really appreciate you guys. You are the best. Have a great day.